Welcome to Inviews.ai, your AI-powered investment insights hub. Headline: CPI dips to 2.7% in June, bolstering case for BOC easing. In a development that has captured the attention of economists and market watchers alike, Canada's inflation rate continued its downward trajectory in June, reinforcing expectations of an imminent interest rate cut by the Bank of Canada, BOC. The Consumer Price Index, CPI, rose by 2.7% year-over-year, decelerating from May's 2.9% increase and slightly outpacing economists' projections of a 2.8% rise. This marks the sixth consecutive month that headline inflation has remained within the BOC's target range, signaling a potential turning point in the country's monetary policy landscape. The June figures, released by Statistics Canada on Tuesday, represent the weakest inflationary pressures since early 2021, offering a glimmer of hope for consumers grappling with the cost of living crisis. Core measures remain sticky, presenting a nuanced picture. While the headline number paints an optimistic picture, the BOC's preferred core inflation measures tell a more complex story. The average of the central bank's two core inflation gauges eased marginally to 2.75% in June from 2.8% in May, aligning closely with economists' expectations. However, the three-month moving average of these core measures accelerated to an annualized pace of 2.91%, up from 2.52% in May, suggesting that underlying price pressures may be more persistent than the headline figure implies. This dichotomy in the data presents a delicate balancing act for the BOC as it weighs the need for further monetary easing against the risk of reigniting inflationary pressures. Market reaction and rate cut expectations. The latest inflation data has significantly influenced market sentiment, with traders ramping up their bets on an impending rate cut. Overnight swap markets now price in a roughly 90% probability of a 25 basis point reduction at the BOC's July 24th meeting, up from 80% prior to the CPI release. The Canadian dollar weakened in response to the news, while government bond yields retreated, reflecting the market's growing conviction that the BOC will continue its easing cycle. Sectoral breakdown: housing costs remain a key driver. Delving deeper into the data reveals that housing-related expenses continue to be the primary contributors to inflationary pressures. Mortgage interest costs surged by 22% year-over-year, while rent prices climbed 8.8%. Notably, when excluding shelter costs, the CPI rose by a mere 1.3% annually, underscoring the outsized impact of housing on the overall inflation picture. Food prices, another closely watched category, increased by 2.8% compared to the previous year. Conversely, durable goods prices experienced a 1.8% decline, offering some relief to consumers. Policy implications and future outlook. The June inflation report, coupled with recent business outlook surveys indicating subdued inflation expectations, appears to have tipped the scales in favor of a rate cut next week. However, the persistence of elevated service inflation and the uptick in core measure momentum may prompt the BOC to adopt a measured approach to future rate reductions. As Canada navigates this pivotal juncture in its economic cycle, all eyes will be on BOC Governor Tiff Macklem and his team. Their decision next week will not only shape the near-term trajectory of the Canadian economy but also potentially signal the broader shift in global monetary policy as central banks worldwide grapple with the delicate balance between fostering growth and maintaining price stability. Thank you for watching Inviews.ai, your AI-powered investment insights hub. Please subscribe for more timely investment insights. By viewing this video, you agree to the terms of the disclaimer provided in the description of this video and the channel or page description.